Hello everyone, welcome to the Grow Your Future podcast. I am your host, Zah Azmi, and I'm joined by my special guest.
Oh, special.
Sam Eljerban from the Money Club. Welcome.
Thank you. How you doing?
Good. Thank you for coming in, man.
No worries, anytime.
We haven't had you on for a while.
No.
Where have you been? Too busy but doing tax returns,
Tax returns, tax planning, advising, all the stuff we like to do. So yeah, it's been a while, but happy to be back, man.
Yeah, we need you, man. We need you in the property space.
Happy to be here, man, and contribute and put my 2 cents in.
Fantastic. Well, thanks for coming on.
No worries,
today, what are we talking about today? Property investment mistakes. Right? What not to do, basically, right? Because everybody makes these mistakes, especially young people. I've made these mistakes. The great things about these podcasts is that you can learn from people who have made mistakes, right? You know, one thing that bugs me, Sam, is that you try and tell people that they're about to make a mistake, but they go and do it anyway.
Why do they do that?
I don't know, maybe they just got to experience it themselves, or they just love, failing or whatever. It's like...
But why did they come and talk to you in the first place? That's what I don't get. So sometimes people will come to you for your opinion, you give it to them and the experience you've had with other people, then they run off and do the wrong thing anyway. That's what I don't get. And
you've seen this firsthand, right? Because you've sat through a lot of consultations with me, and people have these dreams of becoming this property investor or property developer, whatever it is. And it's very difficult for them to see the future because they haven't lived for that long. A lot of our clientele are younger and they see the glitz and glamour of property investing and what it can provide. But they forget that there's a process in between. There are steps that you have to take. And I guess what we want to do today is talk about common investment mistakes that we see every day.
Yeah.
Stuff that I've experienced myself, you've experienced, and we want to teach our listeners, like, maybe don't make these mistakes because they're actually quite common.
We've been there, done that, or we've seen someone do it, and we're trying to save you the same pain. Really, because we've talked about property being a big acquisition. If you stuff it up, it can set you back a lot. So it's probably worth listening to some of these pointers because they can save you a lot of time and money down the track.
Well, we've been in the game for a while, Sam. So, you've had, the pleasure of seeing, me grow as a property investor, and you've also seen many clients grow as property investors, and even yourself, right? So you've lived through some cycles, you've seen the ups, you've seen the downs. We're currently in a really big up, and this is where a lot of mistakes are made when there's a massive boom. When there's a massive boom, people get overconfident and they start over leverage and they borrow a lot of money and they buy. And this is where, because everything basically lifts in price.
Yes, yeah.
And people feel that they're invincible, right? Money's cheap, right? Government's giving a lot of incentives out. Prices are rising. Double-digit growth. The media is really pushing it. It really is probably one of the biggest booms that we will experience in our generation. So it's really important to do things right.
And not to make a mistake now. Money's so cheap. A lot of people can get loans now and invest in property. What you really want to do is not get caught up in all of these areas that are booming that may not sustain that growth down the track and will come back a bit. And you don't want that to happen. So really it's very important to not get carried away, do your numbers, talk to people and really select a good asset that will continue to grow, not just get caught up in the fuel that's being fanned.
It's very easy to do, right? You open up the newspaper every day and you just go, it's the biggest boom in history and all of that sort of double-digit growth. And you've got the narrative is that, there's going to be double-digit growth in the next two to 3 years. And you've got people like all the top economists. You've got the head CEOs of banks, like Big Four banks, saying this is the biggest boom in history. Yeah. Like, these guys have a pretty fair idea what's happening, right? Especially the banks.
Yep.
And, people will just take that and go, all right, realestate.com, let's just trigger happy and buy. Which, look, you do need to take action, but we don't want to get overly confident and take uneducated decisions and start acquiring assets just willy-nilly. We need to have a clear strategy. And I guess that's our first mistake.
Yes.
No clear strategy.
Very famous quote fail to plan, you plan to fail. So I think everyone we deal with together as a combined sort of advice, or tax and property separate, we'd always be looking at what the person's trying to achieve and then building some sort of framework about how to do that. So if you're not doing that, really just shooting in the air. You're not planning anything. You're not going to have a direction to take. You're not going to have goals to try and achieve. You're really going to be flailing around, which we see a lot in people, and that's why they come to us. They want some guidance, which is what we can provide.
And I must admit, Sam, when I first started in property investing, like that was me. I didn't have a clear strategy. It was just about accumulating assets, trying to buy as much as possible. I didn't care what I bought. I would just buy. And I bought off the back of the GFC. So I bought in that dip. So I was able to get, a really good opportunity. And then just like what's happening now, post GFC, prices went through the roof, and I got to take advantage of that growth. And then I kept recycling that equity. But I guess you could put that down to really good timing. Right?
Which is hard to do. Timing a market is very hard.
I was lucky. I'm just going to say I was lucky, right? And I capitalized on that luck and was able to recycle that equity and just keep going and going, which eventually led me to a clear strategy. But wouldn't it be great if you had a clear strategy from the very beginning? Time and time again, we get people coming in here saying, Zah, I want to buy an investment property. And what happens? They just buy anything.
Anything, just to say they bought something.
That's right, but they don't think, okay, how is that going to affect the second one and the third one and the fourth one? How many times have we got people coming in going, Zah, I want to buy an investment property, but maybe in 2-3 years' time I want to live in it. Like, isn't that a shit strategy? Like, that should not be your strategy. Your strategy should be, okay, I'm going to invest in property because I want to make money, I want to build wealth. What is the best option for me at this period of my investing career, and where does it want to get me? And I think that's one of the things that people lack, is that vision of the destination.
That's it. And just that example, that's a conflicting goal. He's buying an investment property but wants to be a home. They're two completely different types of purchases which you don't want to mix up. So very important thing. Biggest mistake, no strategy. It's always going to trip you up if you don't start at least with some sort of plan.
Let's go back to the buying the own home, right? Because it really bugs me, because people are constantly telling me, even this morning in one of my client meetings, a guy said to me, he goes, look, what should I do? Should I buy the house that I'm should I buy a house to live in, and then maybe invest later? I'm not too sure if I want to keep living with my parents. And there was all these emotional factors involved. And it's like, it's really hard to answer. It really is hard to answer. But if you're talking investment-wise, don't buy the home that you're going to live in, right? Like, just rent everywhere that you want to live, right? Then you've just got no drama with being tied to a mortgage anywhere, and just focus on banking money, right? And accumulating assets. I mean, to me, that's a great strategy. But so many people get caught up in this, like, I have to have this home as maybe my second purchase or my third purchase. Like, forget all of that, right? Have the strategy of just building wealth. So, rent vesting, right? We're big on rent vesting, right? Rent where you're going to live, that's close to work and where your life is, right? And then think about buying the home maybe 10, 20 years down the track. That could be a great strategy. You know, we've got plenty of clients. They're accumulating assets. They're on the 10-year acquisition strategy. That's where they're trying to buy 10 properties in, say, 10 to 15 years. And then once they've grown and they're at a point where, like, they've got a bit of money to burn, they've got capital, you've got equity, like, going through the roof, use that equity to buy a home. Because I just feel like people are coming in saying, okay, I want to invest in property because I know that I need to grow my capital, right? I want to increase my wealth. But what really roadblocks them is they go, oh, but my wife wants to buy a home as the second purchase. And it's like, that really stuffs your strategy up.
It's a safety thing, a comfort thing. They want that security. But really, when you're coming down to an investment decision, it's all about returns. If you buy your home, yes, you're exposed to the property market, but your cash flow is ruined. That mortgage is going to kill you, depending where you buy. And if we're talking about investing where you're really looking at return on your money, putting your money into an asset that's going to give you the cash flow, that's going to help pay it off and allow you to grow further than buying the home would, you're going to be wanting to invest in property instead of living in the property.
So I think what it comes down to, Sam, is going, okay, what are my objectives here, right? Do I want to buy the home so I can live in it, and tell everybody that I own at home and I've got that security and all of that stuff, you know what I mean? Or do I want to build wealth and have a portfolio of assets that are going to pay me a passive income for later on in retirement, right? Now, they're two different strategies.
That's right.
But, okay, buying the home that you're going to live in, it's not necessarily the worst decision you're going to make. It's actually still a good strategy because you're building wealth, it's tax-free, all of that sort of stuff, right? So there are benefits to it.
Yeah.
But decide.
Yes.
It's one or the other. Focus on the strategy, stick to the process, and just don't divert, right? Because what happens is people buy maybe 1-2 investment properties, then they go, all right, I'm doing all right now. I feel like I've accomplished a bit. I'm going to go and buy the home that I want to live in because, I've just knocked my girlfriend up, right? Like, what we need to remember is that, no, we embarked on this journey for a reason. And I think the common problem is they don't have a vision. So the objective is a target in terms of a number. The objective is some sort of passive income goal, right? Stick to that strategy, stick to the program, trust the process, see it out, right?
Most people come to us because they're trying to grow their wealth, right? And we will naturally try and do that as best we can when we talk to them. And that means investing, not buying the home. Buying the home, we've done a lot of podcasts about how it's not a bad thing, but it can hint your growth. So if you're wanting to grow, then maybe stick that aside and do that later.
And this is the reason why I don't deal with owner-occupier type of residency. Like, people look at me and they think I'm a construction guy and all of that, and which I am, right? But I'm more so a numbers guy. Hence the reason you and I get along so well, Sam, right?
Yeah.
The numbers just stack up when you invest, right? It's more tax effective. You can control a whole lot more real estate. The banks love it because of the rental income, and it's going to pay you more, right? Let's move on to the second common mistake. People focus on the property itself and not the investment. So this is another example of, people come in here thinking, oh, Zah builds houses and he's a construction guy, he drives a nice truck and, he's always on site. But in actual fact, it's the investment side of things that is more important. It's the numbers, right?
And it ties into what we just said about really buying homes. When you're looking at an investment property, you don't want to get emotional. It's all data driven. That's why people come to us and yourself particularly. Looking at the numbers of an area, do they stack up? What can I do? What can I invest in? What's my maximum? It's all numbers based. It's got nothing to do with, do I like the furnishings? Do I like the roof colours? It's nothing to do with that. So following on from planning what you want to do, the focus on the property is going to be a problem. If you're looking at that, you need to look at the numbers.
So one of the most common problems, right, Sam, is that when they come into the office and they say to us, all right, what markets are you investing in right now? And it's like, well, let's go back a step. What do you actually need, right? As an investor, what are we trying to get out of this? Because do you need cash flow? Do you need capital growth? Do you have any other assets in your portfolio now? Are you exposed to a certain market which we need to now go diversify your holdings in? Like, there are so many factors that we need to put down on paper before we even talk about the actual property. That's right. And that's why with our strategy sessions, it's all about the client. It's all about the investor. It's all about them in terms of what they want. When they start asking about markets or are we doing houses or townhouses or apartments, I shut them down. I go, hang on a second.
What are we trying to achieve?
Back that shit up, right? Because what we need to figure out is exactly what are we going to achieve, right? Is it rental income we need? Do we need capital growth because we lack capital? Do we need a launching pad to get more equity? Each property is going to do a different thing. Not all property is created equal.
Each person has their own very unique situation and goals, really, and own thoughts on what they want to do. So you really do have to customize your approach, which you do, and come up with the solution.
So one of the most common mistakes is that people just go on realestate.com and just go, all right, I think this property could be good, but why? we've got to figure out, okay, what are we trying to achieve? So most of our clients that come in, they actually don't even know what property I'm going to recommend them until weeks or months later. And you know what? They don't care about the property at the end of the day, because if it suits their needs, if it meets their objectives, and they can get everything they want out of that vehicle, as in the property, then it doesn't matter what the property is.
That's it.
Right? It doesn't matter what it looks like. Doesn't matter where it is.
No, as long as the numbers stack up, and that's what we're in a numbers game. That's it. It's just property is the vehicle. That's it.
What's the third one, Sam?
Third one is thinking short term, not long term. I've seen this a lot in my space, in the tax space. There would have been a few years back when a few mining towns were going off. Massive yields. Low entry points, massive yields, which attracted a lot of people. Rightly so. But what happens...
What type of yields are we talking about, Sam?
Well, they were like 10%.
Wow.
10%.
That's massive.
So I had one client, or a few clients actually, many clients got caught up in these yields. They might have already had an established portfolio, so they were able to maybe venture out in these areas, but they did get burned. I had a client invest in Gladstone, some in Port Hedland, these areas, quite rural areas with only one economic driver in the town. What happened after the mining boom? Properties halved. So he won in one situation. We had a client buy at about $500,000 purchase price. He was getting about 70K rent a year for 3 years. The mine packed up, left. His property dropped back to 240 grand, but he had a mortgage on it for 400. He had to liquidate other properties that were going very well just to settle that mistake he made. So if we're talking mistakes, just be careful about yields. Usually when there's a massive yield, there's a reason behind it. So don't get too caught up. Talk to people. Talk to people like us who can tell you maybe have another think about it.
It's a great example, Sam, of people sort of getting caught up in the moment and getting that short-term cash grab. That's what we call it here.
It's attractive, man.
It's it's luring, right? It sucks you in. We've got plenty of examples of I guess we can tie in the last focus on the property itself, not the investment, with a client that I have, where we've bought him a property and it's done very well in a suburb that's grown in the last 10 years over 100%.
Wow.
Right? That's actually better figures than, say, Bondi.
Yeah.
Right? But when we first bought this property 3 or 4 years ago, we looked at it and we went, wow, it's a piece of shit. Like if you looked on realestate.com and you didn't know your numbers and you didn't know your data, you would have gone,
not buying that.
No, I'm not buying this thing, right? It is bad. It's a bad property. But it is located on one of the most exclusive suburbs on the Central Coast. Like you've got $5-6 million houses in that same street, right? So the location data and the analytics, it just matched up for him and his budget and what he needed, right? And now we don't even care about the property itself, because it delivers what we need out of the investment, right? So that client could have gone, short term, I don't like the look of this property, I don't see any value in it, I'm going to drop it. Yeah. But now it's made him like 100, 200 grand, right? So you've got to think long term. And long term, usually when it comes to property, comes down to location.
Yep.
Because the great locations tend to be overpriced, right? The great locations are the more expensive properties. But over the long term, I would rather a more expensive, well-located property than a bargain, discounted, shit property in a less desirable location that's just not really going to grow.
We both think very long term. So when we make a purchase or help a client make a purchase, we're really thinking long term. We don't want to sell it. We don't ever really want to sell the properties we buy unless we really need to. And I think we
want to keep them forever, Sam.
Keep them forever. And if they're in a good spot, they're always going to give you that growth, whether it's yield or capital, to allow you to keep going forward. So really, you don't want to be short term and flick stuff. I get a lot of clients trying to flip. Flip is very risky in that you're needing the market to stay where it is and all these kinds of things. So another short term play in property where people can fall up is really flipping property. You have to have a lot of capital. You have to rely on a few other external sources.
Tax heavy.
Tax heavy. Yeah, there's a lot of exit costs in that. So really, we don't advocate too much in flipping or liquidating an asset once it's developed, because there's a lot of tax implications, selling costs, which eat into the profit. You'd rather just take equity and keep going.
Yeah, and hold the asset.
And hold the asset. It comes down to holding. We're all long term here.
So we're big advocates of the buy and hold strategy. So you've got to think about, okay, if we're buying and holding forever, right? That's the plan. We want to pass these assets down onto our kids and our grandkids. If we wanted to hold, then why are we choosing cheaper locations? Why are we choosing mining towns when those mines are essentially they're going to close down? Right? One day they will, and it won't last. We need to stick to blue chip locations or quality locations. You know, like the Bondis, for example. We're currently here in Bondi, and it's a strong market. Like it will return, on average 10% a year for the next 10 years. Right? You want to be part of something like that. They're the type of land holdings that you want to pass down onto your kids, right? And eventually pay for your retirement. Now, if you can't afford Bondi, it's all good. There are other markets that are very similar to Bondi that are affordable to get into. They might not be in New South Wales. They could be in Melbourne, or they could be in Brisbane, right? Or Perth. Perth's coming up now as well. But stick to those 8 out of 10, 9 out of 10, 10 out of 10 locations, and you won't fail. Now, you might pay more money now in the short term. It might feel like you're overpaying and you're not getting a discount. But those duplexes out whoop aren't gonna bring you value in 10, 20 years time like the houses here in those blue chip locations.
If we're advocating long term, those duplexes aren't really the long term solution you want in your portfolio, which we've gone through many times with different clients.
And I think short term equals to more so just money, and long term is more about building wealth.
Correct.
So, yes, we want money, we want to be rich, but we also want to be wealthy as well. So, you don't just want to have money, because like you said, Sam, with the flipping strategy, you just end up back at square one with money.
You made the money, you're going to have to deploy it again.
You're going to have to do something else
with it. In the property.
Yeah.
Because that's what we're telling people to do, is put money into properties or other assets.
Yeah.
So why do you want the cash?
And there's, like you said before, entry, exit costs. Like, you know who's winning out of it? The government. They get paid the taxes. They get paid the stamp duty. The solicitors are kept in work.
Agents, real estate agents.
Yeah.
They're milking you, man.
It's very capital intensive, the flipping strategy. So buy and hold, definitely all the way. Next mistake.
Over and or under leveraged.
So it can go both ways, right?
Yeah, I see a lot of the time, as a sort of fundamental when I'm dealing with clients, I like to tell clients to borrow as much as they can, even if it's for their home. So we're going in the home space now. Even if it's your own home, because you may want to rent it out later, and you want the maximum amount of debt on that, so you have your other cash is allowed to go elsewhere. So whether it's the home or an investment property, try and utilize as much debt as you can. It's deductible once it's rented out, and use that cash for another deposit or some other use. So maximize your leveraging is what I would generally talk to clients about.
So we've talked about this before, Sam. Our debt now is an asset, right? Like our parents, the baby boomers, they look at debt as bad, right? They want to pay their house off. Both you and your parents and my parents are under that same, old school traditional thinking. Pay down everything and then just live happily ever after. But we now know that you can go further if you keep on borrowing, but it has to be productive debt. And I find that people either fall into two categories. They've got too much debt, right, and they're struggling to manage it, or they haven't got enough. And to be honest with you, surprisingly, most people don't have enough. And we're talking about productive debt. Forget about bad debt for now. We've covered that in many of our podcasts. We're just talking about productive debt that generates income, that's backed by appreciating real estate, right? People don't have enough of it.
Yeah.
If you go to the percentages of property investors in Australia, I think it's like less than 1% of property investors own 5 or 6 or more properties, right? That equates to about 18,000 people in the Australian population. I'm one of those 18,000 people. Yeah. Isn't it amazing that my goal is to make that 2%, right? Or 3%. We need more productive debt because we can do it. So with the right education.
What you're trying to say is really out there in the wide world of Australia or space of Australia, there's a lot of potential, unutilized potential, right? There's a lot of people making money, but not using the ability to acquire debt to put into something.
We're one of the wealthiest nations in the world, right? Like we've got people who clean toilets, and I know this because I used to clean toilets in nightclubs, right? Back in the day, and we were getting paid good money. Yeah. Like these cleaners who come and clean this office, they're getting paid more money than doctors and lawyers from my home country, right? So we are in the wealthiest nation, and we are the envy of every other country in terms of property market, stability of government, safety. Like we are one of the safest countries. Yep. We are generally quite shielded to a lot of the bad stuff that's happening in the world today. So our economy and our real estate market is very lucrative for the right individual who's educated and knows how to invest, knows how to get debt and deploy it in the right areas.
For those of you listening, to try and assess your debt ability to acquire debt, you really need a broker, finance guy. If you need help with that, let us know. And because it's really unknown to a lot of people. I don't think many people would know their capacity. And you do need a professional to help you calculate that.
I'm going to slide in another mistake there with what people do, is they take the advice from just one broker. So one broker, how many times, Sam, have we had clients come in and go, okay, the broker said no, I can't get the loan, and then we've taken it to someone else, and then that broker's also said no, but then we've taken it to someone else and that broker has gotten the loan, right? We need to understand that not all brokers are created equal, right? So that means you need the right team and do not take no for an answer. That's probably a mistake we should put in here. Do not take no for an answer. Be persistent and keep moving forward.
Each professional has their limits, man. You know, some doctors know heaps, some might not know as much. So you get a second opinion when you go to a doctor if you have a health issue. Why not do the same with finances? Use a different accountant, use a different broker. Different people have different skills, different knowledge, different tricks that can help you achieve what you want.
And I guess, you know, it's about just being really creative, right? Like you've just got to know, all right, there's a lot of competition out there amongst lenders, amongst banks. There's a lot of non-conforming banks at the moment who are doing really good deals, right? There's a way. Like if you think that you can't get a loan, there will be a way. Now, if there's absolutely no way you can get a loan, there's always a plan.
Yes.
Right? It could be 6 months, it could be 12 months. But do you know what it is? Figure out what it is and work towards it. So even if the broker's saying no or the bank's saying no to you now, at least you know where you got to be in 6 months. Yes. At least you know where you got to be in 12 months, right? And work towards it. So many people don't have these targets. Their targets are, okay, my next holiday, right? Yeah. The targets are the weekend, right? Like, that's important, I get it, but this is more important.
Yeah.
Right? This is your life.
I had to do that same planning when I acquired my first one. So really, it goes back to that first mistake of people not planning. Getting your finances in order and then seeing what you can actually borrow now is probably the first thing you need to do. And if you aren't able to borrow as much as you need to, then that's the start of your plan. Start planning how you're going to get to that next goal of getting enough debt to acquire that property. So it goes back to the beginning.
Fantastic, Sam.
What's the next
You're
one?
a wealth of knowledge.
What's the next one, mate?
The next one is one that really pees me off.
Why?
People listen to too many people, right? It's just there's too much information and it gets to my head because it's like, why are you listening to all of these different people when you can listen to one person who's done it before and you can tap into their network and everybody's moving in the same direction? But then all of a sudden, you've been distracted by mum and dad. You've been distracted by your uncle who's a mortgage broker. Or you've been distracted by someone else who claims to be successful at this when they're actually not, right? And I just even if they are successful, right? Just pick someone, right? And stick to it. I think too many people get information overload, they get confused, right? And they actually don't even do anything. That's the problem.
There's many strategies out there. So really, each one can be really good. You just got to pick one and go with a person or a team that have done it before and follow them. So whether it's us or someone else or whoever you're listening to, just stick with them. If you keep listening to other people, it's going to cloud your judgment and you're going to stall. Very easy to do.
And you say this saying quite a bit, Sam. There's a million ways to skin a cat, which is, I don't know where that saying has come from, but it's very weird. But there is a million ways to skin a cat. So there's no right or wrong strategy, right? There are other firms out there that are giving really good advice, and their strategies work. It might be different to ours, but they work. But if you combine all of the strategies together, it's probably not going to work.
Correct.
You need to stick to the one. And, if you need to bounce off someone credible.
Correct.
Right? Bounce off someone that you can really trust, who's been somewhere where you want to be. Because if you listen to too much noise, it's going to stuff up your progress. And, it'll slow down your growth.
I think just one thing outside of, say, a professional area is just your network, the people you deal with maybe outside of work. Just stick to people that support you, whether that's family, not family, friends, things like that. You really want people that are going to support, encourage you to do these things because they are big things, and people that aren't doing them don't want you to do them. They don't want you to do these things because you might not outgrow them but exceed. Get ahead.
Well, let's think about these people that discourage you, because I still get these people today discourage me, and they might not do it directly, but they might do it indirectly. They might do it through other people. It could be family, whatever it is, right? And the reason why is because they actually love you and they care about you, and it's easier for them to tell you not to do something because then you're not hurt. But if they say, "Oh yeah, give it a crack, see how it goes," but then it fails, then they feel that, they shouldn't have been in support of you. But what you've got to realize is that nothing in life is achieved without giving it a crack. You've got to take some sort of risk, right? And that's what I say to all of our clients and all of our listeners. I say, look, getting involved in property, there's no guarantees. You just never know. You cannot guarantee any investment,
That's
really.
Right, pretty much.
But you can mitigate the risk through really good education and teaming up with the right people. And going back to what you said, Sam, surrounding yourself in an environment where people are pushing you towards that direction.
Yeah, half the people that touch base with us are just people that don't have these people in their network already to talk about tax, money, finance, property. They just need someone in the space to soundboard with and talk to about. So really they see the need and they're wanting that sort of connection and support, which is what we can provide.
Yep, that's what we're here for. That's what the podcast is here for. And, you can always lean on us for support. We'll never tell you to slow down. We'll always tell you to grow.
Pretty much, mate. What's the next one, mate?
Choosing quantity over quality.
Oh, we've seen this many a time, probably in both spaces again. If we're thinking longer term, like we always do, quantity is not going to get you there. It's the quality ones. So you could buy 10 properties worth 200 grand each in a shit area. It's not going to perform for you. I'd rather spend 2 mil in a good area. It's going to grow over time. So very important thing to consider when you're venturing into this space.
I think the new target for would-be investors or even current investors now should be $1 million.
Yeah.
The $1 million is the new 500 grand because of inflation and where quality is moving. You can pretty much guarantee quality in that $1 million price point space. Now, if you can't make that $1 million, that's okay. There are other opportunities out there, but I'm just saying it's a lot easier to find quality at that $1 million price point than it is at, say, 500 grand. At 500 grand, you are sacrificing on location, you're sacrificing on build, and it becomes a lot harder and competitive because everybody's thinking, okay, the $500,000 play is the investment, the standard investment play. So, you get people take that even further, and they're buying properties, like you said, $200,000, 250 grand. And look, nothing wrong with that strategy, but you're going to have to buy a lot of them. And I always say this, right? To fix a toilet in a $1 million a broken toilet in a $1 million property compared to a $250,000 property is going to be the same price.
Yep.
So your maintenance and your upkeep is generally the same. So you might as well try and push yourself to that higher price point. So I always say, okay, not everyone can afford $1 million, right? But try and go as hard as you can so you can get the best quality asset in the best location to your ability.
Got to spend money to make money. So the best property you can afford at that time is going to go much better than buying 3 at the same total price point. So you'd rather get the 1 quality asset than 3 inferior, anytime.
So less is more, really, when you think about it. And this is why we say to people, look, you don't need 10, 15, 20 properties. Like 10 properties would be great, right? And I've far surpassed that now. But realistically, if you're focusing on quality, really good locations, builds that you will keep forever, 5 to 6 properties is enough, really. Even if you buy them at a lower price point, as long as they're quality.
And some of those lower end properties, do you want to hold them the rest of your life? Are they going to be able to be held the rest of their life? You probably want to offload them after a certain time. So spend as much as you can on those investments. They're going to perform over time.
Again, long term, right?
Long
It's
term.
a long play.
That's it.
What have we got? Timing the market instead of time in the market.
We touch on this quite a bit. A lot of people are always trying to judge the market by low if they can. I think just from my perception of the property market, it's hard to really tell where it's at any given point in time, real time, right? You can look back and see what's happening, but it's not very volatile. So it's hard to really find a low point in real time. Shares, different story. A lot of people can do it in the share market. It's very volatile. You can buy low, sell high. It's quite quick. But in the property market, it's quite large. Transactions are big. They take time to decide on. So really, trying to time a market in real estate, I think is probably too difficult to even try. So you just want to get in when you can and ride the long-term wave. Mm-hmm. Is that what you say?
Yeah, well, the long-term play, it goes back to long-term thinking, right? Like, I've bought property at the top of the market before, and a lot of people have said to me, oh, you're an idiot. Why did you buy there when it's, coming off the boil now, it's on the decline, and, for the next 2 years after that, I hated my life. But, now, I think it's been 4 years later now, I'm loving life. Like, we're back past those peak levels, and I don't regret it one bit. Now I'm getting phone calls from those same real estate agents who told me you're an idiot to want the listing now to go and sell it, right? Yeah. Which I'm not selling, because we're all about buy and hold and keeping forever, right? But, I don't regret that one bit. Now, this goes back to stop thinking short term and think long term. Over, the 25 years, for example, the property market's grown by 7.5% in the last 25 years, right? So do I care about the dips in between? No, I don't. I just cared that I got into the market. I just cared that I took action and just accumulated that asset and moved on to the next asset. Too many people try and pick the market and get too smart and get real complex with it. And you know what? Those people don't normally do anything, because there's always an excuse, right? Okay, the market's down. People go, oh, it's a bad time to buy because, property's going down in value. And as you said, Sam, you can't pick the bottom of the market. It's impossible. How do you know the day when you go, all right, it's at the absolute bottom now. I'm going to buy today because it's at the bottom and it's going to go up tomorrow. You're never going to pick it, right? So those people that say, okay, it's not a good time to buy a property, they're obviously not going to buy. And then when it starts going up again, like now, it starts to boom, they go, oh, it's a bubble. It's going to burst. It's not going to last long. We're going to get a crash. So what are you saying? Like, you're never going to buy a property then. Because when it's going down, it's not a good time to buy. When it's going up, you think it's a bubble.
It's too expensive,
Hey, just buy.
Yeah.
Right?
It's going to, the short-term thinking is going to stall you. You're trying to make a margin on the market. It's too hard to do. It's very hard. And it's a lot of risk. That's why they don't pull the trigger.
Look.
Because they know they can lose a lot of money doing it.
all these people laughed at me, you know, back in the day. Why are you buying property? It's always going to go down. It's going to crash. It's too high. We're in a bubble. We're going to hit a recession and all that bullshit, right? And we did. We hit the peaks and the troughs, and you know, we had to ride through the storms. But look at me now. Yeah. I'm rich, right? So we need to remember that it's time in the game, not timing the game, right?
Aside from the actual property market, think about timing of when you could have started instead of timing the market, but time in the market. If you could have your time again, would you have started as early as you can?
Okay, let me just bring up something, right? I talk to a lot of older people who are in this industry, and you know, a lot of property investors, a lot of people who do what I do, and every single one of them will say, I wish I did more earlier. Every single one of them. You will never meet an older person who's an investor or a property owner that says, you know what, I wish I bought less property.
Yeah.
I wish I wasn't in the market as much. You never hear it. My mum said it to me the other day. She goes, oh, I should have just bought more. If I bought more, I would have been like really sitting pretty right now. You know what I mean? And look, they're doing all right, but you know,
learn from them.
Yeah, and that exactly what I said to my parents. I said, look, your legacy, right, like that you left for me, is to buy more property. You've just basically taught me, buy more property. So you know, like it's everyone, like even if they're, you know, 5 or 10 years older than me, they're saying to me, Zah, like, do more because you can.
And that would have been back when interest rates were quite high. It would have been very hard to get into property. They're still saying, I should have done more back then.
They say take more risk.
They didn't care about this. They wanted to know, I've had money in the market long term.
Because they've lived through it, Sam.
Yeah, that's it.
And they've gone, the peaks and the troughs aren't that bad, right? But they also know that, you know, correct management along the way is what you need, right? And so, you know, hindsight's a beautiful thing, right? But you can't turn back time. So most of our listeners, they're young people. Yeah. So get started. Come up with a plan. Look, we've got to move on. Yeah. Selling instead of refinancing.
Oh, I see this a lot, as you would.
Well, I've made this mistake before.
And what was the mistake? Why? Why is it a mistake?
Because I had bad advice, right? So I sold an asset for around $550, $570, and you know, that asset, if I held onto it today, would be worth over $1 million. And I could have refinanced that and pulled out the equity that I needed, which I thought that I needed to sell for. Yep. But I had some bad advice, had a bad bank manager back then. And when you think about it, he should have encouraged me to refinance it because it would have been more money for him.
Yeah.
But anyway, you know, it was a mistake. I've learnt from it, and you should never sell unless you're really, really desperate and you're pressed, right? Another mistake is I passed in an asset at an auction. It was a house. It went for $460,000. If I bidded $461, I probably would have got it. But I was like, nah, forget about it. I walked away from it. That same house just recently sold for $1 million. And that was probably about 6 or 7 years ago now. So, you know, like, again, hindsight's a beautiful thing, but learn from my mistakes. Just get in, right? Even if it's going to cost you an extra $1,000, just get in.
And that's why you're saying you're buying good assets that are going to keep giving you back. That's why you shouldn't have sold it, right? You know now that would have made me $500,000, which I could now play with. But you lost it because you sold it. Well, another thing to touch on just quickly, the sale costs. Selling instead of refinancing is going to cost you a lot more money. And if you've already purchased a really good asset, which you would have done, you don't want to sell it because you're going to lose the asset firstly, but then you're going to have to pay capital gains tax and sale costs, legals, all these kind of things.
There's a lot of costs involved.
Eats into it.
You don't really end up with that much money. So, you know, I'm only just explaining 2 mistakes there, right? And those 2 mistakes equal, in terms of opportunity cost for me, $1 million.
It's a lot of money.
$1 million. I've only just said 2 mistakes. Now, I'm a book full of mistakes up here, right? And I'm only saying 2. So learn from us. Moving on, this one's one of your favourites, Sam.
Oh, not protecting assets. Okay, so I deal with a lot of people, obviously through tax advice and things like that. A very important thing to consider when investing in property or even going into business. So I'll touch on property. We see a lot of people buying with multiple owners and maybe family or friends, which can convolute things down the track. So I would say, really consider how you're going to buy and who's in your life and who you want to be involved with, because they are essentially your partner and they'll be assessed accordingly moving forward with you for the life of the property. We had a few people that have bought with friends and things like that. It makes it quite difficult. So in terms of protection, maybe just determine who you want involved in these big acquisitions, because a lot of their affairs become your affairs. Another thing with property is, or asset protection, is maybe different vehicles. So maybe not your own name, trusts, there's super funds you can get. You can get a company to invest in property. So if you're in a highly litigious area, you might be sued in your job or your business, or you are in business and you're dealing with a lot of people and you could be exposed. Maybe seek different types of structures to help you protect those assets you're acquiring. So they're the main ones I come across.
So who should people talk to when they've acquired, maybe 2 or 3 investment properties, they're owning their own business, they feel that, okay, they might be a little bit exposed to lawsuits or something like that, and they've worked really hard for these assets, Sam.
Yep.
What would you suggest for people to go out and, who do they talk to when they want to start asset protection?
What I generally see as an accountant, my background as a GP in finance, right? In the financial
general
world.
Practitioner.
In money, really. Mm-hmm. So a lot of people come to accountants for a wide array of different things, and usually your accountant will help you point you in the right direction. Usually they need a lawyer involved, depending on the situation, but the accountant will have some answers. If you do have, say, investments already built up in your own name and things like that, substantial equity, there are a lot of different types of creative legal products out there which we have available to us that can protect that equity. So you might not have started in a good asset protection vehicle, but you can utilize them down the track. So if you are concerned about that kind of thing, there are a lot of different ways you can achieve that protection.
And we can help people with that, right?
Help people with that.
Yeah.
We've got some products out there to protect equity.
Yeah, so. And you helped me with mine, right? So I didn't buy in the correct entities to begin with, and I, came to you, to Dr. Money, right? And you said you set up these structures for me, and now I'm totally protected. And mate, sue me if you want. Give it a crack.
You're protected, mate.
The last one, last example. The last mistake is probably the biggest mistake I see. It's probably the majority of population.
Yeah.
The majority of population make this mistake. Sam, what is it?
Not taking action. I delayed my action probably too long, as you probably say yourself. Getting into property, you always want to start earlier, and it's a big acquisition. It's going to be one of the biggest purchases of your life, so it can stall a lot of people. But you really want to take action. Get people on your team, get people in your network that are going to help you, and pull the trigger as early as you can. It's going to really help you out down the track.
And I guess it's easy for us to say take action, right? Because we've done it before, and and we're doing it for clients every day. We're in the game, but we've got to remember that the earlier you get into the market, that compound effect it just has a life of its own. Like after 10, 15, 20 years, like you end up getting to a point where this sounds really weird, but you actually have too much money.
Yeah.
Right? Like it gives off that much wealth, and it's really hard for you to envision right now when you might not even be in the market yet. But when you have a bucket full of assets and you're past that 15, 20 year mark and it's all paying for itself, or it could be paid off, it just grows in value and it becomes this monster, right? And you actually don't know what to do with your wealth. And it's a beautiful spot to be in. And like the earlier you start, the sooner you're going to be able to get there. It is a long journey. So, it's important to take action first, because once you get that first one going and then you get the second one and you get bitten by the bug and it becomes exciting, you just want to keep going and going and going. So that first step is really, really sort of the most important. And that's what we're here to help you do.
Yeah. If you don't take the first step, you're not going to get to the end, right?
You got to be in it to win it, Sam.
That's it, man.
You got to be in it to win it.
That's
now, Sam, Dr. Money. thank you for jumping on today.
No dramas,
Much
man.
appreciated. I really enjoyed our chat.
It was very enjoyable.
I hope you guys at home or wherever you're listening to this from, maybe your car, you're really enjoying this podcast. And look, we thank you for listening, and we will see you again in the next couple of weeks. See you later.
See you guys.